Hi, and welcome everyone to this Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it's certainly a pleasure to be back here with all of you again. I think the last time I was on here was October 26th, so it's been nearly 6 weeks. I know when I left last time, the market was a little shaky. Things have improved since then, but I hope the last 6 weeks have been good for everybody. Hope you enjoyed the holidays. Still got some more holidays to go. Be safe. And enjoy the holidays with family and friends. But I'm sure you're not interested in me talking about holidays. So let's get into the market and some of the things I think are really going to be important. I will share my screen so everybody can see it. First thing I want to point out is that we are having a fall special at earningsbeats.com. It comes to an end at midnight on Wednesday. So tomorrow, midnight, that will be the end. It's our best deal of the year, so I wanted to make sure everybody is aware of that. If you go to earningsbeats.com, both plural, earningsbeats, and just scroll down a little bit, you'll see right here in the middle of the page our fall special. If you click on that, you will find a few different plans to choose from. So whatever fits your budget, the further you go out, the more you're going to save. You can actually get a full year free if you subscribe for 3 years. So each one of these other plans, they're shorter time frames, they're less money, but you don't get as much benefit in terms of the bonus months and so forth. And I think you'll find that what we do at Earnings Beats will appeal to just about every type of trader. So let's go back to October 26th, because I want to give you a reminder of one thing I talked about back then. So this was the video, and I pulled up an S&P 500 chart. And back then, the market was going down. We were in one of the worst. Well, we were in the absolute worst week of the year historically on the S&P 500, and that dates back to 1950. The October 22nd to October 27th period is not a period to mess around with if you're a bull. We've had some really rough weeks during that time of the month of October. And so I had pointed out that we still had 2 more days of that to go, October and October 26th and 27th. We had some pretty rough historical days ahead. But once we got past the 27th, I provided some pretty good information and indicated that the October 28th to November 5th period, this 9-day period, was the best 9 consecutive day period of the year. And I also said second place wasn't even close. This is unbelievable how historically the market as of October 27th, for whatever reason, tends to just get rid of all of its bearish thoughts and it's full speed ahead to the upside. So let me first just go in and show you what has happened in the last 6 weeks. So there are the percentages from October 28th to November 5th. These are annualized returns. Keep in mind, the S&P 500 averages going up 9% a year since 1950. So if these were just equal, if all days were equal in the market, we should see a lot of 9% or thereabouts on these days. It's not really what we see. We see just unbelievable bullish annualized returns for this 9-day period. And I want you to look at what just happened, how this whole rally got kicked off, starting on November 28th, right from the close on the 27th, just like clockwork. Look at the move up right through. There's November 6th. So this was November 5th right here, or November 3rd. So that's the period right there. That's so bullish for stocks. And look what just happened. It kickstarted. We went from the bottom of this channel, this down channel, to breaking out of the channel during this 9-day historical period. Pretty amazing. So there was your October 27th close right at the bottom of that channel. And boom, that led us out of the correction and into the next phase of the secular bull market. So now we're in December. All right. Got another few weeks to go, 3-4 weeks, I guess 4 weeks before we move into the new year. Can't believe 2023 has gone by so fast. If you're like me, you realize that this is probably, as you get older, these times just seem to go by faster and faster. The years just fly by now. Anyway, going to be 2024 soon. So what does December 23 look like, 2023? Well, normally it looks like money rotates to value. And that's what I want to talk about today, because that's what we've seen so far in the early part of December. We're seeing that rotation again, and that is what we typically see. So what am I talking about? Well, let's take a look at some seasonality charts. I'm going to start off with the IWD, IWF. So what I'm looking at is the IWD, which is the ETF that tracks the Russell 1000 value. And I'm comparing it to the Russell 1000 growth. So it's large cap value versus large cap growth. And I'm just comparing how this large cap value ETF does relative to the large cap growth throughout the various calendar months and dating back 20 years. You can take this little slider and grab it here on the left side, and you can just drag it back and forth, but it only goes back 20 years. You can go back a little bit further, but you have to drag it that way. It'll only give you 20 years at a time. Anyway, over the last 20 years, what I would say, first of all, is when you look at this, the December period kind of sticks out. And it sticks out because if you're looking across the bottoms here, this is the average relative performance over the last 20 years. There's only 2 months where value has outperformed growth, at least the IWD versus the IWF. Only 2 months where we have seen average relative strength in value. And that is, the best month is December, where it's averaged rising about 1% better, outperforming by roughly 1% versus the IWF. And then September, which is about a half of 1%. All the other 10 months are flat or down. So September makes sense to me because, number one, it's the third month of a quarter. So you're past all the earnings. So I think it's a sell on the news with a lot of those growth companies and movement back into value. I think that's part of it. And then the other thing is just September is usually a bad month. And so most people, most investors, most traders will hunker down when things start to get rough. You move to more defensive or value-oriented stocks. And so I think that's why we tend to see a little bit of outperformance in September. December, just the end of the year, I don't know exactly why, other than it's the third quarter or the third month of the fourth quarter. Again, we're past all the earnings. Middle of December tends to have a little bit of a rough spot. I think that's where the value picks up a little bit as well. But value outperforms growth, at least the IWD versus the IWF during the month of December. And I actually had checked it out. I think if you look across here, the best month of the quarter is the third month of each quarter. So March, June, September, and December. And if you add those across, I believe you'll come up with 0.6 positive. So in other words, the third month of each quarter, value cumulatively outperforms growth. And I think that's important to realize because, again, you're past earnings season. A lot of the growth stocks have made big runs in the first 2 months of the quarter, first leading up to earnings and then after earnings making a run. And then you get past all the earnings reports, which generally most of them are out by about the middle of the second month of the calendar month or calendar quarter. And that's when I think you start to see a sell on the news impact in the stock market. So any third month of calendar quarter, I'm going to be thinking a little bit more value oriented, but especially September and December, because over the last 20 years, those are the 2 months that actually have outperformed. So keep that in mind. Second chart I will show you is, I'm going to bring up the IWM versus the QQQ. This is also a seasonality chart. And what I want you to look at how things start to improve in November and December. November and December, 1.9% average outperformance over the last 20 years. Small caps versus the large growth stocks, large cap growth stocks. So IWM versus the QQQ. November and December, both are positive. December, it outperforms, the IWM outperforms the QQQ the most often, 65% of the time. And it's also outperformed by the most 1.3 percentage points on average during the month of December. You've got November, which goes up 0.6%. June, the relative strength in the IWM is about 0.8%, and February 0.3. Those are the only 4 months that are positive going back over the last 20 years. The other 8 months are down, flat to down. And particularly the first month, first and second months. But if we go across here and just look at the first months, January minus 0.3, April minus 0.9, July minus 2.0, October minus 1.2. If you add those across, you'll come up with 4.4. So the IWM underperforms the QQQ by about 4.5 percentage points during those 4 months, the first month of each calendar quarter. Why? The QQQ, most of the big components of the QQQ report earnings in the first month. Many small cap companies report later. It's the large caps that report first. So the small caps are not in a position to take advantage of any earnings. And that, quite honestly, they don't perform as well. Their earnings aren't as strong as some of these larger cap technology names and so forth on the QQQ. So that's where we see a lot of underperformance. If we move to the second month of the various quarters, February, May, August, and November, if you add those 3 across or 4 across, you'd come up with minus 0.7, minus 1.8, minus 1.2. So again, you're seeing an average of below 0. So the IWM is underperforming the QQQ. And IWM tends to do a little bit better when we get value, we get more value-oriented stocks performing well. And part of the reason is up in the IWM, the three largest sectors, or the 3 biggest sectors that represent the IWM, are the healthcare, industrial, and financial sectors. So all of those are more defensive or value-oriented sectors. And those are the 3 that are the largest sectors within the IWM. So it makes sense that when value is outperforming, we're going to tend to see a little bit better performance in the IWM. And that's what we see here on this chart. And that's why we tend to see maybe just a little bit more strength in that third month of each quarter. So here, March minus 1.3, June plus 0.8, September minus 0.1, and then 1.3. I think I said weakness, but that's when we tend to see the strength in the third quarter or third month of every calendar quarter. And if you add those up, it's going to be minus 0.5, minus 0.6, plus 0.7, which is better than the other, the first months of the quarter and the second months of the quarter. So we're in December. This is a sweet spot for value. It's a sweet spot for the small caps. And fortunately, we've been seeing that action. So I pulled up a long-term chart here, the IWM, to take a look technically at what's going on. So we talked seasonally. Let's look technically at what's happening. Here, back in 2018, 2019, for the most part, outside of maybe this 1 month period with the trade war, we traded for 2 years within a fairly narrow range. Most of the action was between 140 and 160. A little bit on the outlier side on both ends. So maybe it's 138, 162, I don't know. But we stayed basically in that range, and then had the pandemic, and of course rallied right back out. Once we went back through that double top right there, we absolutely exploded here on the IWM. And look at the 253-day rate of change. 253 days, trading days, represents a year. So here, small caps went up about 130% in 1 year after that pandemic. That, we immediately bounced off of the pandemic lows. But then when we got back through this double, triple top, whatever you want to call it, we took off. And where we've pulled back to, notice now we're coming back down to the 160 area, and it's been holding. That was the prior resistance. Now it's support. I believe this is the move that's going to take us back up through 200. Seasonally, we got another strong month. January and February, IWM tends to perform equal to the QQQ. And the QQQ tends to be pretty strong in January. So I'm looking at the next couple months being fairly strong for the IWM, unless things change under the surface. But for now, I'm looking at least to go back up and test that 198, 199 area on the IWM. Let's look at the XLF versus the SPY. So here's the financials. And again, the financials, remember, they're value oriented. They love the fourth quarter. Going back 20 years, you can kind of just see the XLF relative to the spider is actually positive October, November, and December. That's not the case in other quarters. First quarter, we go down 2.2%, the XLF relative to the spider. April through June, minus 1.2% if you add the three across. July through September, flat. October through December is the only quarter where we have seen financials outperform the S&P 500. And remember, this includes the fourth quarter of 2008, where we had the financial crisis. The XLF tumbled. So even with that, you can see this quarter still is the best quarter. So we're in the fourth quarter, and we should be expecting some of this rotation that we've been seeing. And I think the financials are one of the areas that have benefited the most. I think industrials have started to show some nice relative strength as well, but financials to me is where most of that relative strength has been. So let's look at the technical picture of the XLF, because again, I'm not a huge fan of financials over the long term. They tend over time, even during secular bull markets, financials tend to go along with the S&P 500. They don't tend to lead for long periods of time. So if you look down here at the bottom, we're seeing relative strength. This is the XLF relative to the S&P 500. And we're seeing that relative strength, which has taken us to a relative high that we had not seen since back in April. Now, on an absolute basis, price action is getting close to the high we saw in February. So we've got to get back through 36.5. That's going to be a challenge because we haven't been above 36.5 in any meaningful way since April of 2022. That's over a year and a half ago. So we got to get through 36.50. But if we do, I would suspect that we're going to see some more leadership. Maybe we move up to this relative high in April. Beyond that, financials need to prove to us that they're going to continue to lead. I would be looking maybe for rotation back to some of the other areas like technology, discretionary, communication services, and so forth. So anyway, that's what I had for today. Again, if you want to check us out over at Earnings Beats, you can do so by going to earningsbeats.com. Not only do we have a fall special that I really encourage you to check out, if you just want to try us for 30 days, that's free. Do that. But please be safe through the holidays. The market will be here after we're done with the holidays. So let's all try to be safe. If you're traveling, safe travels. Enjoy this time with your family and friends. And I'll continue to provide what I see in the stock market. Have a great day, everybody. Enjoy the holidays. Happy trading.